Welcome to the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Get ready. You're about to get the fastest hour and 10 minutes that you've ever seen on Bloomberg Television, coming off that Federal Reserve meeting. But more importantly, Katie, a look ahead to more than 24 companies reporting earnings, including 4 of the biggest in the world.
Yeah, absolutely. 15% of the S&P 500's market cap in the form of 4 of the Mag 7, but also expecting earnings from Ford, from a few other industries such as Mattel. So really a nice smattering there.
But of course, the stars of the show are going to be Alphabet, Meta, and Amazon. As well, we should also point in there, Microsoft as well. Of course, these have been the pillars of the artificial intelligence rally, a rally that ostensibly kicked off just about 3.5 years ago with the release of ChatGPT. It has morphed from a technological race to a financing race, and that is going to be a big focus when those earnings cross the wire in just a few minutes. Pleased to say, joining us right now here in Studio 2 is Mahal Katz. She's the head of investment and corporate banking over at Mizuho Americas, and she's had her hand in overseeing some interesting financing deals in the technology space over the past few years. And I want to kind of talk about some of the activity that we've seen, particularly when it comes to tech M&A, tech project financing, et cetera, and just the idea of just how important it is for that financing, for this deal activity to continue. Well,
thanks for having me on Wall Street's Super Bowl Wednesday. Clearly a busy day with both the earnings as well as the Fed decision. But maybe kind of take a step back when you think about deal activity and where overall investor sentiment has been. Like coming into today, I think the expectation was very much for higher for longer and an expectation that the Fed would be on hold, just given the fact that inflation still is above the Fed target. And when we listen to earnings, whether it was the cohort that has already reported, and we can talk a little bit about the ones you just mentioned in a minute, what we are expecting. But that environment has very much in Q1 of this year has been a carryover from 2025. 2025 was very much characterized by mega deals. The financing markets have been constructive. Investment grade had hit records in 2025. And even in Q1, you saw financial services coming into the market post-earnings. But even beyond that, you've seen the hyperscalers looking to finance their data center build-out in support of AI. The one area, which is leveraged finance, has been a little more nuanced, where the market has been more selective, and that has impacted one area that differs Q1 versus 2025. In 2025, we saw some return of sponsor activity where they participated in, called it a third of M&A volume, whereas this year it's down to 25%. Again, higher cost of capital has impacted their ability to finance LBOs.
Well, that's what I'm curious about. I mean, we just had this Fed meeting today. I mean, we have yields up, benchmark yields up today, about 10 basis points on the anticipation that we are higher for longer, if you believe what was in that statement today here. So does that make the job that much harder? Is it going to get harder?
So there are a couple of aspects when it comes to it. You know, sponsors had been incredibly active coming into the most aggressive tightening. And so the cost of capital has risen for sponsors, which has made monetizations of some of those investments over the last couple of years more challenging. One, they had come into those investments at a higher multiple than the exit multiples that are available today, because despite the fact that we have seen the markets at record levels, we also know that there has been a concentration of value into a Mag 7, whereas the 493 are trading at different levels. But higher rates clearly make it more challenging to finance leveraged transactions.
Let's also bring geopolitics into this conversation, because that has been one of the big unknowns that has entered the market since the end of February. And it was interesting. It looked like maybe we were cooling off when it comes to the IPO market and the initial knee-jerk reaction there. But as we've seen over the past few weeks, even today with Bill Ackman's IPO finally getting off the ground here, it doesn't seem like that's necessarily been the restraint that maybe some were worried that it had been.
So there are a number of aspects. The IPO market has reopened last year, similar to the fact that the M&A market had seen mega transactions getting done. Deals that were getting done in the IPO market were also larger scaled companies, and some that are in the pipeline are some of the ones that are hitting the headlines on a regular basis. I do think that there is a whole pipeline, pretty robust, of companies that have been sitting on the, I wouldn't call it sitting on the sideline, but have stayed private longer and are ready for prime time. The markets have shrugged off a lot of that geopolitical tension, perhaps in anticipation of getting some ramp off over the coming weeks. And so that has, in some sense, allowed PicPay, PayPay, Venture Global last year, Medline last year, and you mentioned Persian today.
Yeah, absolutely. And I do also want to get your perspective on what is going on in private credit, because you rewind, and you think about where we were in terms of the conversation when it comes to February, a little bit in January too. There were a lot of existential concerns about software, about the private credit industry's exposure to software. And I mean, that story is still playing out. So I wonder where you think we are in it.
So private credit has grown as an asset class over the last decade or so and has really come into the market where traditional banks have been constrained due to regulations coming out of the global financial crisis, and it played a very important role in helping finance. They also benefited from a low-rate environment that the ZIRP era had enabled us to do. What happened in March of 22? The most aggressive tightening. And so companies that had been leveraged have found it harder to support their debt coverage ratio. With respect to private credit, there are a couple of nuances, which is they started out in the mid-market and their exposure has broadened into some larger transactions. They've also opened their investors into the retail base, which has perhaps a different risk appetite,
right.
And that has put some pressure. But to answer your question, which is kind of where we are, I would say the following. If you put aside the tricolor and the First Brand headlines and categorize them as idiosyncratic, by and large, the market has yet to really discern between software that has truly been impacted by the AI disruption, and software that is a system of record, has inherent moats, deals with proprietary data, and is truly hard to rip out, versus software which is more horizontal in nature and can be replaced by a bot. In terms of, so overall exposure is kind of, call it 20-25% of the market. I do believe that it is manageable.
Right. All right, Michal, that is a good place to leave it. Really appreciate you taking the time on this very busy day. That is Michal Katz. She is Head of Investment and Corporate Banking over at Mizuho Americas. Meanwhile, of course, we do want to get a little bit back to that Fed decision that we got just about 2 hours ago. Let's welcome in Ken Shinoda. He is Portfolio Manager with DoubleLine Capital. So, I mean, you take a look at the market reaction to that hold from the Federal Reserve. 2-year Treasury yields higher by about 10 basis points right now, Ken. It seems like the market is saying basically it's not expecting any sort of interest rate relief to come anytime soon. Is that your reading as well?
Yeah, not only does it not think that there's any relief to come soon, it's starting to price in potential hikes. That's kind of what the dissents were about, that we shouldn't go in with language that the bias is easing, with inflation potentially staying stickier, energy prices higher, uncertainty around the conflict in the Middle East. So I think the Fed's definitely on hold, and they don't know if the next move is up or down.
Well, it's kind of, I mean, maybe they got a little guidance today, because it seemed like just towards the tail end of Powell's press conference, we saw Brent crude top $120 a barrel. And I mean, this is actually the highest it's been in this sort of war cycle, if you will, kind of even above where we were at that 119 level in early March. That seemed to be a sign. And at the same time, we should point out, the president was at the White House talking about continuing what he's calling his blockade of the Strait of Hormuz here. That's inflation, Ken, isn't it?
Absolutely. I mean, the longer energy stays elevated, that pushes into food prices, transport prices, manufacturing of goods. The longer gas prices are higher, that's going to squeeze the consumer. So the higher we stay here, it's going to push on inflation, it's going to push on consumer spending, and ultimately it could be bad for growth in the long run.
Well, I want to get a sense here, too. I mean, particularly as an investor, and particularly in the shorter end of this market here, are you actually seeing opportunities? Does this push you to the sidelines? What?
Yeah, we like the front end of the curve. You can find really interesting credit assets that still have spreads 100 plus to the short end of the Treasury curve that I think offer a lot of value. We've seen a move here on the 2-year up towards 4%. So now you can get kind of 5+% in short duration assets. You're actually picking something up versus T-bills that that inversion relative to short-term rates is gone now. So I think you're going to see more and more money kind of move out of money markets out into kind of low duration type.
Hey, Ken, hold that thought here. In conversation with Ken Shinoda, portfolio manager with Double Line Capital. We are getting the closing bells here in New York, relatively unchanged for most of the major indices, but that could change with some of the earnings that we are getting now crossing the wire, and that includes Qualcomm, the redhead crossing the terminal right now. It involves their third quarter forecast. The company says their revenue will be in a range of $9.2 to $10 billion. That's light. The top end of the range is below the average of street estimates of $10.3 billion. Adjusted EPS for the quarter, the current quarter that we're in, look for a range of 210 to 230. Again, the high end of that range is below the average of street estimates of 243. Katie, as far as the most recent quarter that just passed, the company did beat on the bottom line, and it did come in relatively in line on the top line here. The company also saying that it does see in the current quarter, in the third quarter, Katie, a bottom to the Chinese handset market slump here. The idea here that maybe as we get deeper into the year, we could see a little bit more improvement.
Okay.
You can see Qualcomm shares moving lower after hours. Do want to quickly bring you Amazon crossing the wire right now. The big headline here, Amazon first quarter net sales beating estimates. First quarter AWS net sales XFX higher by 28%. That is above the estimate for 25.7%. You can see the first quarter EPS beating estimates as well. So the look behind looks pretty good for Amazon, but you can see shares moving lower right now, down about 5%. Second quarter net sales, the look ahead there, seen between $194 billion to $199 billion. The estimate had been for $189 billion. So again, that range is higher than the estimate, but still, as you can see, shares dropping right now.
Results from Meta and Microsoft now crossing the wire. Let's get right to Microsoft here. On the revenue side for the most recent quarter, a beat, $82.89 billion. The street looking for roughly about 81.5. EPS coming in at $4.27 for the Azure business in the fiscal third quarter, the quarter that just passed. The company says Azure and other cloud revenue did jump about 39%. That's just slightly higher than what the street was looking for at about 38.2%. And revenue here overall, once again, just to reiterate, $82.89 billion. We're going to dive a little bit deeper, Katie, to get those CapEx numbers, but let's get right to Meta.
Well, actually, I do want to bring you Alphabet right now because first quarter revenue, it is coming hot and heavy right now. First quarter revenue coming in at $109.9 billion. That is above the estimate of $107.1 billion. Also interesting in the other category, Alphabet saying that Waymo surpasses 500,000 fully autonomous rides a week. Shares moving higher by about 2.3% right now. And this is a company that had been performing pretty strongly year to date, Romaine.
Let's get right to Meta here because seeing some activity there, particularly with regards to its CapEx guidance that is now being raised. The company says full year CapEx will be in a range of $125 to $145 billion. The previous range was $115 to $135. So basically a nudge up of roughly about $10 billion on the CapEx side. For revenue in the most recent quarter, the company, for revenue in the current quarter that we're in, the second quarter, the company says expects $58 billion to $61 billion. The high end of that range slightly above the average of street estimates of 59.56. So the street is basically right in the middle of that range right there here. And one more number I do just want to give you there. On the operating income side for Meta, for the quarter that just passed, they did see about a 30% jump to about $28.9 billion. So all around, it looks like these numbers are coming in slightly higher, both in a good way and potentially in a bad way. And that's why you see the shares down about 4.5%.
Yeah, let's reiterate that full year CapEx number because that certainly seems to be taking markets' attention right now. Full year CapEx seen between $125 billion to $145 billion. As Romaine said, the previous range was for $115 billion to $135 billion. We know that Meta has been particularly aggressive when it comes to their CapEx spend. We know that the logic there is basically that is boosting engagement. It's boosting sort of ad targeting on their social media apps, but it's also been causing a little bit of agita among investors. And perhaps that's what you're seeing right now in shares after hour, Romaine, down about 5% for Meta.
Absolutely here. And it's going to be interesting to see the difference in market reaction. Let's just flip back to Microsoft for 1 second because those shares are higher by about 3%. We are starting to get some more numbers here. First, I want to talk about the CapEx number that we had for the fiscal third quarter. The CapEx, including leases, actually came in below estimates, $31.9 billion. The street was looking for roughly about 35.3. So we'll see if the market interprets that as good or bad. Cloud revenue at $54.5 billion. We should also point out the company says that consumer cloud revenue on that Microsoft 365 did jump about 33%, but commercial cloud revenue, that was up about 19% here. So a lot to parse here, Katie, right now when we talk about some of these numbers here, and more importantly, how the market is going to react. We should point out we've seen a pretty massive outperformance by names like Meta, Alphabet as well. Microsoft had been somewhat of a laggard, so that could account maybe for some of the difference that you're seeing in market reaction. Gil Luria is standing by right now. He's Managing Director and Head of Technology Research at D.A. Davidson. I don't know if you've had a chance to catch your breath here, Gil. A lot of numbers crossing the wire, and I don't know, maybe you can kind of make sense of it here. Are we looking at a good thing or a bad thing right now when it comes to these four major hyperscalers?
It's a good thing, and the difference in stock reactions really just has to do with how high the expectations were. It looks like in the three critical data center businesses, the hyperscaler businesses exceeded expectations. They're all still accelerating. AWS, Microsoft Azure, Google Cloud, accelerating, still growing faster and faster. And that's a very good sign in terms of the progress of AI. That's a key takeaway. The stocks are reacting differently because expectations from AWS were for even higher, and for Microsoft, investors were a little more skeptical. But both look good, as does Google Cloud. From an initial look, it looks like advertising for Google and Meta is also strong. That has to do with the broader strength of the economy. Amazon, the retail side, looked good. Has to do with the broader strength of the economy. So I'd say, yeah, overall, first look is a positive look from all these companies.
A positive look for all these companies. And you, of course, know it was a couple of days ago where everybody was kind of wringing their hands over that Wall Street Journal report about OpenAI and its sales and internal metrics that, at least according to that report, were falling short. And, of course, everybody started looking at this broader AI ecosystem, particularly the hyperscalers. The idea, let's face it, all these names we're talking about right now, they have basically been the main financiers, if you will, of this build-out. Do you get the sense here that these companies will remain committed to some of these CapEx forecasts? And more importantly, do you think they feel confident enough to articulate some sort of return on investment, or at least being able to communicate that to investors?
Yeah, we'll find out soon enough. A lot of it's going to be in the commentary on the calls, but yes, they are seeing very strong demand. That article about OpenAI was really a backward-looking article, and it was a little out of context because one of the things that happened to OpenAI is that Google Gemini did so well, is that Anthropic is doing so well. Overall, if you look at across Anthropic and OpenAI are at a $50 billion revenue run rate. They were at 0 2 years ago. That is the ROI. By the time you add what Google's getting in revenue and the direct revenue Amazon, Microsoft, and Google are getting from selling these services, the returns are showing up. The demand is off the charts. We know that because Anthropic is compute constrained. So we're likely to hear very positive commentary about demand. The subtlety will be the supply side. Can we build data centers fast enough to supply that demand, given all the bottlenecks, CPUs and memory and advanced packaging and optical and turbines? That's where a lot of the conversation is going to be. But I would expect the commentary over the next couple of hours to be very positive about the demand environment in AI.
And Katie, I just want to point out, too, I mean, they actually did talk about those Gemini enterprise numbers, 40% quarter-on-quarter growth, she would point. So basically talking about the sequential growth here. So pretty substantial growth there.
Yeah, absolutely. Well, Gil, I do want to talk about CapEx specifically in the context of Meta, because you take a look at shares right now down more than 5% after hours. They did boost their full-year CapEx guide. And, I mean, this is something that Meta has gotten dinged for in the past. We know that they're trying to offset those costs when it comes to maybe shrinking the workforce. But when you think about, you know, the year ahead, all of this CapEx that's coming through, does it make as much sense for a Meta to be spending these types of numbers?
It does not, because Microsoft, Amazon, and Google are selling most of that capacity. Meta, it's all for internal use. These are very, very high levels of CapEx for internal use. Unless they start selling external capacity at some point, This is coming out of their shareholders' pockets. And that's why shareholders are reacting strongly. Whenever the CapEx and the OpEx from Meta grow faster than the revenue growth, which is substantial, investors react badly to that because it's all for internal use. Where again, Microsoft, Amazon, Google are going to talk about how the demand from the economy, from consumers, from enterprises is rising. Meta is only using it to train its own models and deliver its own models.
So, Gil, where does the story go for Meta then? Are we just setting up for another year of efficiency? We know that we ended up in that situation a couple of years ago. And to some, I mean, we're looking at a very similar sort of backdrop right now.
Yeah, I think that part of the answer is going to be that the OpEx is going to have to decline going forward if they're going to increase CapEx that much. And then at some point, either Meta turns around and starts selling that capacity or slows down this CapEx. And at the very least, delivers a model that's competitive. Right now, the frontier models that are coming out of Meta aren't even in the top 5. We have OpenAI, Anthropic, Google. Then we have some Chinese. We have Grok. Meta's not even in the top 10, I would say, in terms of its frontier model. Unless they show they can be competitive there, investors are going to expect them to either calm down on the CapEx or reduce enough OpEx to allow margins not to be degraded. The good news for Meta is the top line is still growing very fast. Again, the advertising business is very strong. And they make the argument that because we're so good at AI, that's why we're selling so many more ads at higher prices. That only goes so far.
So as we get to this barrage of conference calls, I'm not sure which one you're going to pick to be on since they all are kind of overlapping. It gets to this idea, Gil, of what you really want to hear, not so much just about, OK, what we're going to spend or what the return is going to be, but the actual deployment of this, exactly how this is turning into an actual business, whether it's a business division or whether it's going to become, for some of these companies, maybe the entire business altogether.
That's right. We're going to want to hear about execution. We are going to get the data centers out. This is the type of return we're getting. This is how we're going to keep our margins in spite of all this spend, in spite of the depreciation that's coming online. That's what investors are going to expect here. Discipline and a plan for how these returns are going to come in. Again, we think they're already coming in based on what we're hearing from OpenAI and Anthropic, but we're going to need to hear that, especially from Microsoft and Amazon that are investing so much to support OpenAI and Anthropic. We want to hear a plan from them about how that's driving returns, how they can accelerate growth while maintaining their margins in order to justify this continued CapEx rate.
All right, Gil, really great to get some time with you as we sift through all of these different earnings. That is Gil Luria. He is Managing Director and Head of Technology Research over at D.A. Davidson. And we keep the conversation going into these reports from these tech giants and what they could portend for their fellow behemoths, Apple and NVIDIA. Let's discuss with Daniel Flax. He is Senior Research Analyst over at Neuberger. So, Dan, I mean, pick your poison here because we're seeing a lot of movement after hours, a lot of different directions coming through right now. But it seems like the common element between all of these big names reporting is what's going on with CapEx. Before we get specific here, would love to hear your thoughts first on the billions and billions of dollars that these companies have committed to building out their AI hopes and dreams.
What we're seeing is that the execution on these cloud and digital infrastructure build-outs are healthy. Obviously, that is benefiting companies like NVIDIA, which we continue to own and think has attractive prospects. The key, though, is if one looks at Google Cloud or Amazon Web Services or Microsoft Azure, they're deploying the capital and then they're getting the returns. And so when we speak to customers, you're seeing a broad-based reinvention of the digital infrastructure, generative AI, new workloads, really this re-architecting of enterprises and businesses that's underway. And so, yes, there's going to be pressure on the free cash flow in the near term. But when I look at Google or Amazon or Microsoft, I think they're going to come out of this period stronger with more durable businesses.
And I mean, you raise an interesting point. I mean, you think about the suppliers here. It's a good reminder that, the CapEx numbers that we're talking about, they support an entire ecosystem of companies that, derive their entire business from what these big companies are spending. So, I mean, you take these numbers in context. Do you think that that's enough to keep the momentum going that we've seen in the Philadelphia Semiconductor Index, for example, which is about to close out in enormous April?
I think we remain selective, and I think what's going on is that companies that can execute on their product roadmaps, NVIDIA, which we talked about, Broadcom, these companies are really increasingly strategic to partners such as Google and Amazon. And so these cloud build-outs are certainly going to remain lumpy, but this explosion of new workloads that's underway is creating value for the customers, the cloud companies themselves, and their partners, such as an NVIDIA and such as a Broadcom, two names we continue to like here.
I do just want to just kind of step back for a second and just kind of recap where we're at right now with a lot of these earnings. You see Alphabet shares slightly higher here in the after-hour sessions, up about 2%. We talk about a quarterly revenue and profit in the most recent quarter that did beat expectations, and obviously a lot of this has to do with the continued expansion that we've seen in that cloud computing unit. Meanwhile, we have Microsoft. Those shares are down as well. They're also showing strong expansion in their cloud computing unit, Azure, but maybe still some concerns here about just how much they're spending. Then, of course, you have Meta, which is to a certain extent a completely different story here. The CapEx spend continues to go up and expenses continue to go up even outside of that main CapEx. And, of course, that causes people a bit of concern as well. And then you have Amazon. Amazon Web Services, their net sales for the first quarter beating estimates here. When you take a look at even the other businesses outside of that, strong growth as well. But again, the negative reaction there in the share price may be a reflection that investors wanted something a little bit more. And Dan, I do want to talk about that too, because with some of these names, we've talked about a phenomenal run up in the shares. And I do wonder if some of the knee-jerk reaction, and it is knee-jerk, we're only 10 minutes into these earnings reports right now, some of that is based on valuation, or do you think some of that is based more on longer-term structural concerns about how they're shaping their business?
I think in the very near term, given the move that the stocks have had, the market's going to want to better understand the trajectory for these businesses over the next few quarters. Each one of these companies has different business models. If we take Meta as an example, they don't have a cloud business, but their digital advertising business remains robust. And so their costs are increasing as they are for everybody, in memory as one example. And so seeing their CapEx go up, I would expect them to continue to grow CapEx at an aggressive rate next year. The question and the focus really from our perspective is really enriching the user experience on one side, delivering value to advertisers on the other, and continue to ensure that these experiences are vibrant. If they do that, I think we'll see strong double-digit growth. And as we move through the next few quarters, market will be more comfortable. Google, they're reinventing search, and I think they have a long way to go.
So, Dan, I do just also want to ask you about another company, and this kind of feeds into the earnings that we're going to get out of Apple tomorrow. Qualcomm reported, of course, a big supplier in the handset market. Everybody wanted to know how the handset market is doing. Still weak, at least based on the customers that feed into Qualcomm's earnings. The company does say they see a potential bottom in that in the current quarter. But what is the read-through, if at all, to what we might hear from Apple tomorrow?
What's happening in the smartphone market is that as memory costs go up, the price of the units, particularly in the low and the mid end, is getting impacted. And so that's causing weakness in parts of the smartphone market. In the premium tier, and Apple notably, demand is actually quite healthy. And the key is that the experience on devices in these so-called edge environments is becoming richer. And so Apple, you'll see that with their devices, more on Apple Intelligence over the coming months, including with the new CEO, John Ternus. I think Qualcomm, which is a supplier to the Android vendors, they're continuing to innovate, and that you're seeing content growth in the premium tier. Specifically, though, with Qualcomm, they're continuing to pivot their business under CEO Cristiano Amon to more automobile content where they've had good success, the Internet of Things. And that journey is underway, but I think they're executing well as they make that transition.
Dan, always appreciate it. Dan Flax, Senior Research Analyst over at Neuberger. Now, I should point out, with all the focus we have on the tech names, the two biggest gainers in the after-hours trade, Carvana and Ford. Carvana up about 9% after beating on several metrics, and Ford up about 2% right now in the after-hours trade after boosting its full-year outlook, citing strong demand for some of those high-margin pickups and SUVs. Joining us right now, I'm pleased to say, is the Chief Financial Officer of Ford, Sherry House. All right, Sherry, let's get right to it here. For the most recent quarter here, the numbers look pretty decent, though we should point out there was I guess, a one-off that we got with related to, is that a reimbursement for some of the IEEPA tariffs?
Well, yes, you're right. We had a fantastic first quarter. We just delivered $3.5 billion in adjusted EBIT. And this quarter does have a one-time tariff receivable in it. What that is for is we paid tariffs last year between March of 2025 and February of 2026 of about $1.3 billion, and we now are going to be getting that back in the form of a receivable. But even after taking that into consideration, we had a really strong beat this quarter, about $1 billion. And what that's comprised of is we had global revenues that were up about 6% for the quarter. And that really is based on strong net pricing. We had great product mix. And also our share of revenue was the highest it's been in 5 years. Also contributing to this quarter was our pro software and services. Now, this is super important for Ford because this is recurring revenue, and it was up 30%. And that has gross margins in excess of 50%. And then finally, we've been on track with our cost savings as well. And we are on track right now to get another $1 billion out this year in both material cost as well as warranty. Yeah. And that's going to be in addition to the $1.5 billion from last year. And as a result, we raised our guide.
You did. You raised that full year EBIT guide by roughly about $500 million, $8.5 billion to $10.5 billion, up from $8 billion to $10 billion. Though there's a big asterisk here. I mean, you make it clear that that guidance does not include the potential impacts of what's been going on in the Middle East. Have you had a chance to sort of assess that impact, and when do you think you might have to maybe adjust that guidance as a result?
Yeah, so we right now are looking at consumer sentiment. We're also looking at the forward curves, and the forward curves are still holding that this Middle East situation is going to be more on the short-lived side. You know, as a result, at this point in time, we are believing that there's going to be some recovery as we start to exit Q3, as we get through Q3 and Q4 for the balance of the year. So at this point, our forecast presumes that it will still be high for a couple of months here in terms of fuel prices and energy prices, but we do see some retraction maybe in Q3 and Q4. We will be watching that very carefully, and we will, of course, be back with any types of adjustments as necessary.
Absolutely, Sherry. I mean, you think about affordability right now, that's absolutely a concern. Gas still above $4 a gallon. And you mentioned consumer sentiment. We know that that has been in the gutter for a while here. And, you know, I wonder if you take a look at past cycles, if we stay around these levels with these different sort of cross currents, how does that typically impact what you're seeing when it comes to your SUVs, when it comes to your pickup trucks, which taking a look at the past quarter, it looks like those sales have been particularly strong.
Yeah, what's interesting is we are in a different situation than we were in past periods when we've had fuel shocks in the past. What's a bit different is we've got a lot stronger powertrains out there that are much more capable with a lot more miles per gallon. So we've got a big lineup of hybrids, of plug-in hybrids, and also battery electric vehicles. So you have a lot of our customers are in those products as well. Another thing that is different is the fuel cost as a percentage of disposable income is now lower than it was in the past. And finally, as we look to our truck buyers, we find that they are actually quite resilient. And part of the reason for that is we have our pro business, our commercial business, and there our truck buyers, this is a non-discretionary spend item for them. It's really, it's part of their vocation. They're hauling, they're towing, they need these vehicles. So we're not seeing much of an impact as of yet, and partially because we have such a strong multi-energy lineup that our customers can turn to.
Yeah, it's a good reminder that those pickup trucks, for many people, not discretionary, as you said, it's a staple. But even still, with this environment that we're in where you do have higher gasoline costs, the narrative has entered the conversation that maybe you are seeing EV sales, hybrid sales being boosted by that. And I know, we only have about a month or 2 months of, this playing out. But are you seeing any truth to that when you take a look at your own lineup?
Well, we're seeing that used car prices and EVs are starting to go up a little. And there was a bit of an increase in EV sales in March, but we thought that might have been a bit more attributed to some of the competitors adding some incentive spend versus a structural difference at this point in time. So there might be some small green shoots showing that there might be an EV increase, but at the moment, we're not seeing anything substantial.
Just real quickly, Sherry, I am, though, curious, too, when we talk about whatever the future of EVs are. And I mean, I see, we're still kind of anticipating a loss. And I know that Ford's kind of making that transition with a runway, I guess, out to 2029, where we start to see all of that smoothed out here. I don't want to use the word abandoned, but have we just kind of pulled back completely from an EV build out at Ford? Or is there going to be a reset of that, a material reset of that in some way?
We have far from abandoned EVs. In fact, we are as focused as ever on them. We have just become more focused on providing products that are affordable and also profitable. So our brand new universal EV platform that's planning to come out in 2027 is designed to be affordable. And this is going to be a fantastic product. Also, we're looking at a lot of other multi-energy products as well. So we are investing in more hybrids across many of our nameplates. So we're going to be offering, really, by 2029, our expectation is about 50% of our fleet will be electrified, and that's up from about 17% of our fleet in 2025. So a big run-up ahead, and we are every bit as committed to EV and multi-energy as we've ever been.
All right, Sherry, that's a good place to leave it. Really appreciate you taking time on a busy afternoon. That is the CFO of Ford, Sherry House. Meanwhile, let's get back to those big tech earnings. Google, Amazon, Meta, and Microsoft all on the move in the after hours. You can see taking different directions here. Let's welcome in Bloomberg Tech co-host Caroline Hyde. And Caroline, it is pretty striking to see that the only gainer in that board was Alphabet. Talk us through what exactly we learned in the past 30 minutes.
Well, I mean, Alphabet just continues to show such stellar growth in its cloud area. More than 60%, the market had braced for more than 50%. But this is where the vertical integration, the fact that they're designing, making their own chips so successfully that others want a piece of the pie, and maybe they start actually being a real competitor to NVIDIA here. But also the advertising juggernaut continues to spin, and this ends up being a flywheel effect. People adopting AI, Gemini usage going up, even in the enterprise as well. That might have surprised a few people, where we think Anthropic, OpenAI have really been the areas of pushing into the enterprise. So Alphabet managing to really show why it started to gather steam in terms of a stock price perspective. Well,
you mentioned the advertising. Well, let's go to Meta, because they're an advertising company. I know they think they're a tech company, but let's face it, they're an advertising company, and it's still a juggernaut of an advertising company. Totally different reaction in the shares right now, down about 5% in the after hours trade. At least the narrative based on our Bloomberg reporting. Some concerns here about the higher cost of investing in AI.
Spending too much in terms of capital expenditure, but also I think there is that risk of how much advertisers are going to be pouring money in the future. You've got these regulatory overhangs coming in the EU and the US. Think of the 2 court losses that they've had, the worry about addiction, the worry about addiction of teens to social media being thought to be at the blame of a company like an Alphabet with YouTube, where I saw advertising actually pull back a little bit, and indeed with a Meta. Is that enough to then help question the capital expenditure that continues to rise? Is really Mark Zuckerberg saying, hey, I want to be a super intelligence company here. Stop looking at perhaps my prowess of the past and look about where I want to be in the future and my new AI models.
How many times have we gone through this with Zuckerberg and the advertising? They're going to get killed because of this regulation, that regulation, and they bounce back. $50+ billion just from ads in the most recent quarter. That's nothing to sneeze at.
They've been Teflon in the past, but this time the CFO is speaking pretty seriously about the potential serious costs that this could have for the business if indeed they do see EU, US regulators move in a different way. So maybe there is enough question marks. But you're right, sometimes Zuckerberg is praised for the ambition and the capital expenditure, and sometimes we punish them. And it's interesting that Microsoft is also getting a little bit punished at the moment, when last quarter it was absolutely pummeled after we didn't see enough growth in Asia. But this time they saw 39%.
Yeah, that's what I don't quite understand, because you think about the bar also for Microsoft. They were down 12% year to date coming into these numbers. Azure posting a 39% revenue gain. The estimate had been for 38% growth. And still, I mean, the stock after hours, you can see down about 1.5%. What's going on?
Well, it does feel as though maybe they're still wanting to know how much is the adoption curve there? How much are we seeing Copilot bring in the revenues? They're talking about more than 100%, 127% jump in actual AI part of the business. Now the revenue run rate going great guns, but more broadly, there has been talk in the market that, for example, GitHub Copilot can't let anyone else on because they just can't build it fast enough. How much of their compute is going out to their own services? How much are they having to give out to the OpenAIs, the Anthropics of the world, the others that they want to be servicing here? So I think there just isn't enough positivity coming out of Microsoft to make people want to go back into the stock, even though Azure was there. It's really been volatile after the market, though. Remember, there's thin liquidity at this time. We have to see whether that holds into tomorrow's trade.
Absolutely.
Yeah, absolutely. And we have to wait, of course, for those conference calls here. And we know how these knee-jerk reactions can flip on a dime. Be sure to check in with Caroline Hyde tomorrow at 11 a.m. Eastern Time, the co-host of B-Tech, where she'll have a fuller breakdown of all of these tech earnings that we just got here in the after-hours trade. We're going to continue to keep an eye on those tech stocks. We are getting a few other names outside of tech reporting, including Carvana, Chipotle, Mattel, maybe a little bit more of a read on what's been going on in the consumer sector. Carvana shares higher this after reporting revenue that beat estimates, sales in terms of actual volume of cars sold beating estimates. Katie, Chipotle, those shares slightly higher here as people are going back to Chipotle. I know you're more of a salad person, but, you know, people still like that, I
am, It's going to be interesting to be able to dig a little bit deeper into Chipotle, for example, because we've gotten some really interesting earnings on that front, you know, just over the past few days. I know you spoke to Starbucks this morning, the CEO over there. We heard from Coke yesterday, basically saying that shrinkflation was working to their benefit. So a lot of these consumer-facing food chains have been pretty interesting in terms of, you know, how they're managing through this environment.
And you also see Mattel there. They actually beat on several metrics here, but you also saw margins compress too. That's largely because of the impact of tariffs, obviously all the volatility in the FX space and a lot of other factors as well. So there's a lot to break down here. And did you remember, Katie Greifeld, we had a Fed meeting today?
Barely.
Yeah, absolutely here. We should point out, not to make light of it here, a big jump that we're seeing today in bond yields here. So investors are going to have a lot to parse when they come back into the cash session tomorrow morning. Let's see if we can get some insights out of our next guest. Nancy Tengler joins us here in Studio 2 in New York, the CEO and CIO of Laffer Tengler Investments. Great to have you.
I'm so glad to be here.
It's a whirlwind day. We could start anywhere, but I'm going to start with earnings for a while. We've heard from kind of the big tech companies. The numbers, I mean, the knee-jerk reaction, a little bit to the downside. None of their numbers were bad, but obviously, you know, there's still some concerns about AI spending, when it's going to pay off. We get a few consumer companies, still some concerns about the economy, whether the consumer will hold up. What are you paying most attention to right now?
Well, great interview this morning with Brian Niccol. I was watching. We're a shareholder. We were betting on him, and I think he is delivering. But we also heard from Visa that spending is up, and so I think the consumer's okay. You've got the Chipotle numbers, not bad. So I think we can kind of rest assured the consumer's working, they're spending. It may not be, you know, massive amounts of spending, but if you add up American Express with Visa, not bad. So,
well, I do want to point out, and you brought up the Starbucks interview, because he did point out something in there, and the idea of having a lot more higher income consumers. Of course, that was also the story for Amex, which traditionally it is. And I do wonder, I mean, I don't want to get too into this whole debate about the K-shaped economy, but when you see Brent crude prices back up, gasoline prices up, do you start to worry that at least a certain income cohort might actually be dinged in a way that would actually affect the economy?
100%. I mean, I think what we're seeing from the One Big Beautiful Bill Act is that refunds may be offsetting higher energy prices, but I think this administration is going to come out with their equivalent of COVID checks for energy costs.
Because you think we're going to get more stimulus?
I do, actually. And I don't have any inside information, but I think if you're sitting in the White House and you look at the polls for the midterms, you're saying, I got to do something. And energy may not come down based on what we're seeing in the Mideast. So I think I'm encouraged by the numbers in that, I mean, he also said, you know, we are aware of that, but we are seeing low-end consumers, coming to us
he
with
did say that. Yep.
like a luxury brand. But yeah, you're right. I mean, that is a problem, and it has been a problem. And I think the Fed would be wise to pay attention to that problem. And so Kevin Warsh's comments that we're going to use the balance sheet, we're going to get rid of the balance sheet as a tool and use interest rates is good for the average American.
Yeah. I just point out, Katie, you know I don't drink coffee. I went to Starbucks on Sunday.
Really? What did you do?
I got probably the least coffee drink there. It was just basically like a milkshake. It was caramel and chips
Love
and
it.
cream and others. It was delicious, by the way.
I'm sure it was.
It was pricey though.
I'm sure it was also very healthy. So
it was not.
They can put protein in it.
They could. I opted against that.
No.
Got to live a little sometimes.
Starbucks, I have some quibbles about their food, but that's a different conversation.
The food, absolutely.
They should improve it, right? I'd spend so
100%.
much more money there. But you'll have to put in a word with me with Brian Niccol. But in any case, I do want to talk a little bit more about Kevin Warsh, because I think how a Kevin Warsh Fed, how it might look different in terms of the communication style is a very fun thought exercise. We did hear Jerome Powell today saying that basically looking at better ways to communicate is natural, that he's never been a fan of the dot plot, and that the press conference at every meeting, it's now the industry norm, but it hasn't always been. And, as an investor in this market, I know that, you like to run a high conviction portfolio, not necessarily like a big macro portfolio, but even that being said, I mean, if we did hear less from the Fed, how do you think that the market, which has gotten used to this style, might react to that?
So I think there may be a pushback on Kevin Warsh initially. I think the market may test him, but I do believe he's right. Like if you go back to when I started in the business, Katie, and sorry to say that was in the early 1990s. Well, okay, mid 1980s, but I came of age during the 1990s, and there was this whole sort of if there would have been predictive markets, they would have been betting on the size of Alan Greenspan's briefcase. But but there was no discussion, and I think that's healthy because we've kind of created this moral hazard of policymakers thinking there's no risk. Oh, we'll just expand the balance sheet at the Fed. I think we have to move away from that and really depend on what's going on at the economy level. I think the FATE, which was flexible average inflation targeting, which was a Powell thing that he embraced in 2020. I think that was a really bad decision for the Fed, and I think we paid for it with higher inflation and then subsequently higher interest rates. Use the 450 economists at the Fed, use their modeling, and then use common sense. And that's what's been missing, I think, from Federal Reserve policy. I hope we return to that, and I hope we get less chatter out of all the governors.
Well, I'm sorry, do you think we're going to see more from the staff? Because, I mean, Warsh has kind of addressed that issue, the potential, and there are other Fed members that have talked about this too, that they would actually want to see more of the forefront coming from the staff rather than the committee members.
And I agree with that, because otherwise we don't need them. And so we've been paying these folks to generate these models that we've been ignoring as an organization. So I think it'll be good to return to fundamentals. I found the press conference kind of disappointing today. I was hoping he would say a little, because he talked about preserving the communication levels and the independence. But what is independence? Like, he's not going to leave. What is that going to do? I just think we need to move away from politics. It's hard when you've got a president who's creating political headlines. But I think the Fed needs to return to the American people.
We literally have 30 seconds, but do you think him staying on as governor is political?
Kind of. Kind of, I do. I think you trust the system, you leave, you do what's right, and hope for the best. But
Yeah, it's going to be fascinating to see that dynamic develop. He did say that he doesn't have any interest, Romaine, in being a shadow Fed chair, but still, the president.
But he'll still be in the building.
Yes, exactly.
Right.
He'll still
in the parking spot.
He'll still be in the meetings where the decisions are being made. Nancy Tengler, always a delight to see you.
So good to see you.
That is Nancy Tengler. She is CEO and CIO of Laffer Tengler Investments. Meanwhile, let's take a look at how markets closed on the day, and we're taking a look at some of the after-hours movers right now.
Oh, look at the turnaround, Katie.
Yeah.
I mean, we were talking about Alphabet being down up 5%, Qualcomm, which was down like about 6%. Look at that.
Yeah, look at that. Quite a turnaround. Not seeing a turnaround, though, for Meta. Certainly that CapEx raise spooking the markets here. But you can see all in all, some big gainers after hours. We're going to keep the conversation going. Up next, this is the close.
We are keeping an eye on this tidal wave of reports out of big tech companies, including Alphabet. The shares now extending gains up almost 7%. Sundar Pichai, the CEO, now speaking on a conference call saying that Google's models have been downloaded 500 million times. Of course, talking about their AI models and saying that the reduced costs of AI responses, it has reduced those costs, I should say, by 30% due to progress. Of course, with this rollout of all of these large language models and, well, everything associated with, there are some questions being raised about cybersecurity as well as the ethics of it all, particularly in what most people think is going to be one of the most transformative technologies in modern times. Now, our next guest spent years working on AI ethics over at Google. This was just years after Google had acquired DeepMind, a company whose founder is actually the subject of a new book by Sebastian Mallaby called The Infinity Machine. I'm pleased to say joining us right now live is Tengler. She's founder and executive director of the Distributed Artificial Intelligence Research Institute. Tengler, great to talk to you once again here. And I do want to start out not so much with ethics, but with the security side, particularly in light of what we learned from Anthropic and Mythos over the last couple of weeks, this idea of the power of what some of these large language models can do. And I guess what should have been kind of a no-duh, the potential negative impact of that if it's used by the wrong people. Are there any guardrails out there right now?
I actually think that everything that we were worried about is getting a lot worse. And to me, it's ironic that Anthropic, that announced itself as the AI safety company, is making all of these things worse. So one example is that they came out with their new model, Mythos, and Anthropic said that this new model can find and exploit vulnerabilities. And now, of course, we're not sure, this new system, I mean, and they haven't told us how much better it is at finding vulnerabilities than their prior models. But the first question is, why are they training models to try and exploit vulnerabilities? That doesn't seem like a good thing. Of course, I have more things to say about the way they're hyping their systems and whether or not we should even believe their claims. But to me, the first thing I'm thinking about is, why is an AI safety company creating a system that is primarily used to exploit capabilities rather than being used in a defensive sort of mechanism?
Well, use the word AI safety, but is it? I mean, you can apply that to all these companies, whether we're talking about Anthropic or DeepMind. Obviously, OpenAI clearly made a decision about the direction it wanted to go in, and of course, a big lawsuit underway with regards to that here. But I mean, should the public, and for that matter, corporate enterprises, even look to these companies as truly being about AI safety?
Absolutely not. And I feel I'm always bringing bad news over here. So maybe one day I'll bring good news to your viewers and listeners. But I feel like we're watching the same movie on repeat. So OpenAI doesn't have as much of a shine as it used to. But when it first was announced in 2015, it was announced as an altruistic company. That was the headline. And Sam Altman was just a few years ago being called an Oppenheimer figure. He doesn't take a salary. He's so altruistic. He's so worried about safety. So these were the kinds of things that were being said about OpenAI. And now the public doesn't seem to be on board with that. But these are the same things are now being said about Anthropic, which was founded by, even in my opinion, more fanatical people than the founders of OpenAI. So I don't think that any of these companies should be seen as AI safety companies. They should be seen as corporations attempting to maximize profit and being scrutinized as such.
Well, Timnit, is that such a bad thing? I mean, you think about corporations, and I mean, their sort of founding principle in a lot of cases is to make money, and especially if we're talking about Anthropic and OpenAI going public, I have to imagine they're commitment and promise to their shareholders is to make them money and sort of be that cold-blooded corporation.
Yes, I agree with you. If you're a company who is stated commitment is to make money, then you should make money for your shareholders. However, what's happening with these companies is that they're not actually showing the numbers, right? They're burning a lot of money. And in my opinion, they still haven't shown how they're going to make all this money, even with the exploitation of labor and the stealing of data that we've been talking about. So even with the unethical practices that some of us have discussed before, they're still burning money, and so many companies are taking on debt to pay for the expansion of data centers because of the promises that are being made about this technology. However, many times when you look at the hype, it does not match up with reality. And so a lot of my work has been scrutinizing some claims, because there are many unsubstantiated claims that come out of these companies and are sort of repeated by the press when they haven't been independently reviewed. And so yes, I agree with you that if your goal is to maximize revenue for shareholders, you should absolutely do that. However, the way in which both OpenAI and now Anthropic have been created have been with this promise, literally saying that they're going to save humanity from so-called artificial general intelligence that might render us extinct. That is what they said that their goal was when they were founded. And OpenAI is right now in litigation because it was founded as a nonprofit, which means that it wasn't paying its taxes to California, to the state of California. Right?
Yeah, a timely conversation that we're having, given to your point. A lot of the key characters are in court right now, but Tim, we don't have a lot of time. But to your point that, we hear a lot of claims out of these companies. You're skeptical, it sounds like, of a great number of them. With that being said, are you excited by the possibility of these becoming public companies, since at least 4 times a year they're going to have to report earnings and step into the spotlight?
I think that maybe that's a good thing. I mean, I'm not a big investor and things like that, so that's not necessarily my expertise. But I feel like it's actually, yes, to your point, it's going to be a good thing for them to be scrutinized in the way that they haven't been in the last 10 years, because they have kind of flown under the radar for a few years by pretending to be a nonprofit. At least OpenAI has. And then Anthropic's whole deal was saying that they're the more ethical company than OpenAI. So OpenAI said they're the more ethical company than Google. That's what they said when they were being founded. And if you hear Elon Musk in court, even, he was saying it was his idea. And the reason is that he invested in DeepMind. DeepMind got bought by Google. And then he was worried that artificial general intelligence, what he believes to be sort of a machine god that's being built, was going to be controlled by Google, which he didn't want. So they said they're going to create a nonprofit to steer this supposed machine god. And so they've been kind of getting away with a whole bunch of claims. And so now, if they're going to be scrutinized just like every other company, I don't know if all of these claims will be upheld.
All right, Timnit, really fascinating conversation. Appreciate you taking the time. That is Timnit Gebru. She is founder and executive director of the Distributed Artificial Intelligence Research Institute. Meanwhile, let's get back to these earnings themselves and break it all down with Erica Brescia. She is managing director over at Redpoint Ventures. Erica, great to have you with us. An embarrassment of riches when it comes to the big tech companies that reported this afternoon. I do want to start with Microsoft. Shares down about 2.5%. When it comes to what they reported in their cloud business, actually better than expected growth. But we know that sort of the investor attention, the focus right now is sort of moving to what we're seeing with Copilot and their monetization efforts there.
Yeah, I mean, I'm not a public market investor. I suspect it's, investor expectations are very, very high. And I think the Whisper net was projecting to come in even higher than they did. But if we look back at the fundamentals, the growth is great. If we look at Alphabet's, 40% quarter over quarter growth of Gemini, that was fantastic. So, I think we're seeing a lot of goodness. And it's important to understand that it's still very early in the days of AI. And unlike your previous speaker, I am thrilled to see the growth in all of these Western model companies. I'm excited for the IPOs to come and what they'll do to the market. And I'm excited that we have some new open weight Western models that are truly state of the art that were dropped by Poolside yesterday. There's a lot of goodness to come. We're in a global battle over AI and AGI, and I'm glad it's happening on our turf.
Well, I want to pick up on one point you made that, you're excited for the IPOs and what they might potentially do to the market if we do see some of these big AI companies come out of the pipeline. And I'll ask you that. What do you think it will do to the markets? What do you think the effect on the private markets where, a lot of these AI startups still live right now? What will that potentially look like?
Yeah, I think their foundation models are building this substrate upon which a lot of other companies are benefiting, right? If you look at everything on top of the foundation model layer, there's so much that companies are going to need to buy to make the best use of these models, to make responsible and safe use of these models. They need AI governance and control like Jetstream provides. They need new cybersecurity tools. The app vendors that are building on top of these models benefit as the companies become more and more successful. The models get better. They can continue to fuel growth and innovation. So I think continuing to have successful models out into the world actually builds this great substrate for others to build on. And on top of that, you've got a bunch of money flowing into employees that will now be more and more liquid. That will go back into the market to founding new startups, which is always good for the ecosystem. And we'll have, the public market governance around these companies and the visibility into how they're growing. And I think that's healthy for, our markets overall.
I am curious, though, also, Erica, just kind of about the cost of this build out. I mean, obviously, we know there's been a lot of financing needed to do this, and so far, so good. But we've heard some comments, including from the CEOs of a couple of these companies, kind of talking about the idea how the costs, to a certain extent, are actually outpacing not just the return so much, but the idea of maybe what you can do with humans. The idea that the LLMs are outpacing those costs. When do we start to see those costs contract just a little bit? The idea that you get some sort of a right sizing where it makes it a little bit more economically attractive to continue pushing forward with this.
Sure. Look, I think there's a few things here. It's true that, there are huge infrastructure buys that are happening to continue to advance the state of the models, but they're getting so good that we're already getting a ton of value out of them. And now, enterprises are experimenting, but we're starting to see those experiments turn into real enterprise productivity gains, and certainly productivity gains in the private sector, as we've seen our companies see extreme increases in efficiency, in product velocity, in growth, and what they're able to accomplish. And, I think we'll see a few trends moving forward. One is that overall token costs are going to continue to come down as we get better at running these models and as we get better at running them across different architectures. Number two, enterprises are going to start adopting a lot more open source models and running their own models internally. Again, going back to our thesis around Poolside, which dropped models yesterday. We're already seeing now that enterprises are seeing they can get value out of the models. They want to get more control over that, get more visibility into costs. And I think the tooling around that is just coming into the market now. And it's a trend that we'll continue to see over the coming years.
We only have about a minute left. And look, I know you're an investor, but I am just curious about the political side. You mentioned Poolside and the whole Horizon thing going on. We had a story earlier today about Brookfield pulling out of a data center project in Virginia, and that was largely because of some of the political backlash to it. Do you worry at all, at least amongst the general public, that there might start to be more of a pushback on some of this technology and, more importantly, a lot of the build-out that is trying to be had here? Do you have any worry here that that could sort of interrupt our progress?
Yeah, I really do. I think we need to be incredibly forward-thinking. Again, this is a battle that the U.S. needs to win, and we need to be building out our own data centers at a clip that can sustain our development and usage of AI. And I think there are a lot of things that are not as well understood, and we need regulation that makes it possible to build data centers where we need them. I think having behind-the-meter power access is an important part of that. And, I think think there are other really interesting efforts for the longer term, like
Yeah.
data centers in space, that I'm excited about and actually quite bullish on, though it's going to take
Yeah.
some time to get there.
All right, Erica, we have to leave it there. We've got to talk about space at some other time. Erica Brescia, Managing Director over at Redpoint Ventures. Meanwhile, right here on Earth, as we wrap up our coverage on this day, tomorrow also going to be a busy earnings day. Not the busiest like today, but we get some earnings in the morning out of a big healthcare company.
Absolutely. Eli Lilly, we know that their shares have been on a bit of a downdraft. A lot of questions about their oral GLP-1. Blue Owl as well. Looking forward to that.
That's going to be big as well. And then after the bell, we're going to hear from Apple. Obviously, a lot of focus will be on the CEO transition, but of course, a lot of focus will be on handsets, and of course, will be on what the strategy is going forward with regards to both hardware, but also their AI strategy. Mark Gurman had a story today about maybe a little bit of a revamp with the Siri and the photos and everything else as well.
A lot of folks would welcome that.
Will they?
Yeah.
Yeah, Siri's not.
Yeah,
Can I say it?
She needs some help.
Yeah. Anyway, also keep an eye on Pershing Square. Of course, you had that dual IPO, if you will, of Pershing Square, and there's the asset manager. Did not do so well.
No, closed at about $40.90 per share. That's the closed-end fund versus that $50 opening.
We'll be back tomorrow with all your Pershing Square news right here on Bloomberg.